Good afternoon, everyone, and thanks for joining us for today's webinar, an update from our good friends at Diamond Hill Capital Management. We heard from Bill and Doug a couple of weeks ago, and so we're just kind of curious if the world has gone to heck in a handbasket or if they've got positive things to tell us today. This is Mark Salter. I'm the CFA Society Minnesota Executive Director. My job is simple: get out of the way as quickly as possible after doing a couple of thank yous and one housekeeping thing. So the first thank you on your screen, there we go, we got it to trigger, is to all of our annual sponsors who generously invest their time, talent, and treasure every year to help us bring you high quality professional learning events like today's webinar. So we can't do it without them, and we thank them every opportunity we get. The other thank you is a quick one to CFA Institute. When the pandemic hit back in the spring, they generously provided a meeting license to Zoom at no cost to societies like ours and others around the world. And again, we can't do this sort of stuff, especially in today's environment, without their support. So we thank them profusely for this license. I am going to stop sharing my screen and in just a second turn it over to Matthew Lerner from Diamond Hill. The last thing I will cover, though, is the housekeeping thing, the essential. How are we doing questions today? As usual, we're going to use the chat function. So please, when you're ready, type in a question for Bill and Doug, and those guys will handle them as time permits and as the topics come up. So Matthew, I'm sending it back over to you with yet another thank you for helping us arrange this event today.
It's our pleasure, Mark. It's great to be back with the chapter here. And to answer your question up front, surprisingly, Bill and Doug, both being fixed income gentlemen, do come with positive news, which you don't find every day in the fixed income world. So I know we'll hear it from them here in just a moment. But before I do turn it over to them, I did want to take a quick second to really just introduce the group to Diamond Hill and share a couple quick comments about really what makes us tick here. Now, for those of you that haven't covered us in the past, we're a smaller boutique firm that was founded in 2000 based off of two main principles that still govern us today. The first is specializing solely in intrinsic value investing. So this is that same Benjamin Graham approach that focuses on a company's cash flow to determine its worth, or of course, its ability to repay debt. And the second is a complete alignment of interest with clients. A couple examples of this are, think of setting clear expectations of what we're aiming to achieve in each of our strategies. So this includes having a stated peer ranking and return goal, so you have a sense of what we're hoping to achieve here. We also have a significant personal investment inside the strategies that we manage right alongside your clients. So through the end of last quarter, we've invested over 120 million of our own dollars across the 12 portfolios that we manage. So all of this leads to building high conviction, benchmark agnostic, and capacity aware portfolios with an objective of adding value for clients. Now with that, I also wanted to mention that next month on Tuesday, November 10th, in fact, it's funny, I've seen some people sign in for that meeting as well, so hopefully they've come over here. But next month on the 10th, I'll be back to host a discussion with a colleague of mine, this time from the equity side of our house, regarding growth versus value. So certainly stay tuned for some of those details that come across. So without further ado, I wanted to turn it over to Doug Gimple, who's our senior fixed income specialist, who'll be moderating a fireside chat with the one and only Bill Zox, who's the co-manager of our corporate credit and high yield funds. So with that, take it away, Doug.
Yeah, definitely. Thank you, Matthew. And thank you everyone for joining us. I don't have a fireside here in my basement, but it is a fireside chat. So we're going to try and keep this a little bit interactive. So we've got some polls that we're going to send out. So hopefully this is my first time doing this. So hopefully it works. But as we get into the questions, and I'm just going to direct some questions to Bill, and then as we get to the questions that apply to the polls, I'll send out those polls, and hopefully we'll be able to interpret what it's saying. Because again, I ask for your patience because I've not done this before, the polling part. So with that, Bill, we'll jump right into the questions. So we've seen a record pace of high yield issuance so far this year, with roughly 350 billion in new issuance through September, which is 68% higher than the comparable time period last year. And 3 of the past 4 months rank in the top 5 monthly issuance volume of all time, as June, August, and September delivered a combined 167 billion in new issuance, or nearly half of the issuance so far this year. Past 2 quarters have averaged more than 138 billion, well ahead of the monthly historic average of 79 billion. Now, with all those stats and numbers, we're going to talk a little bit about the Fed's impact on issuance in the market. But let's talk about how you've been able to navigate this deluge of new issues and how the market has reacted to it as well.
Sure. From a financial market standpoint, the world has not gone to heck in a handbasket. And that new issuance is a very clear indication of that. But what we've done is we've been very active in the new issue market, starting initially in the investment grade market. Even in our high yield strategies, we were really focused on investment grade in the latter part of March when the market first opened up and throughout April. And that was really, I'm sure we talked about it last time, but that was sort of a once in a generation opportunity where you could generate equity-like, let alone high yield-like returns in the investment grade corporate bond market if you did it with duration. If you invested in investment grade corporate bonds with longer duration, the returns were once in a generation, equity-like. But that is all behind us. And we bought a lot of that and have since sold a lot of that since the March, April timeframe. So starting in late April, we focused much more on the high yield market where we're traditionally focused. It's always important for us to be very selective in the new issue market. And the problem is really when you get to be too large and you have a lot of cash to put to work, it can be difficult to do that in the secondary market. So you become reliant upon the new issue market to put that capital to work. And now you're basically buying what Wall Street is selling at any point in time. You never want to be in that position. You want to be in the position where when it's a seller's market, you can step away. When it's a buyer's market or investor's market, you can step up and be more active. And the reality is there's been so many new issues, as Douglas mentioned, that's about 20% of the high yield market, which is about 1.45 trillion, 20% in new issuance in the second and third quarters alone. So that's a massive amount of issuance. So we've actually participated in less than 5% of the new deals, but still have found a lot to do. This happened in an environment where spreads went from close to 1,100 basis points on March 23rd to now just below 500 basis points. So bottom line is the market has absorbed this new issuance remarkably well. There's not been a demand problem at all. And I'm sure we'll talk about that as time goes on. Probably the area where, if I could generalize as to where we're finding the best opportunities over that period of time, one way to put it would be things that did poorly during the financial crisis are probably unduly punished right now, even though they're really in very good shape this time around. It's very different. So examples would be mortgage insurers, mortgage servicers, mortgage originators, regional banks, non-bank financials. That's a broad swath of financials, which were right in the heart of the financial crisis. This time around, they're in much better shape, and we've found lots to do in that area.
So, I mentioned, the sheer volume of issuance in my previous question, but, with such a dramatic rise in issuance over a relatively short period of time, is it safe to say that we're seeing some firms that are coming to the market for additional financing that normally don't tap the market on a regular basis?
Absolutely. And those, we love those situations. But again, if you're too big, you can't really do that because these are one-off issuers and they're not going to move the needle in your strategy. Even if you own 30% of the outstanding issue, which then creates its own liquidity problems. If you're a huge platform, it's not going to move the needle for you anyways. So those large players, maybe one or two will take a look at it, one will end up owning it, and it still won't move the needle. Or if you're too benchmark oriented, you're going to stay away from that, because these one-off issuers are going to be tiny weights in the benchmark, maybe 2-3 basis points in the benchmark. So a position that would have any meaning at all to your portfolio is going to be a massive overweight. We don't manage that way at all. So we love those new one-off issuers, infrequent issuers, new issuers, where they're getting compensated for all these other factors more so than credit risk. And there has been a lot of that. You saw these companies in the heart of the quarantine and lockdown were accessing bank financing or the bank loan market to insure against all of this uncertainty. Now they're coming to the bond market to term out those bank loans. And we've found lots of opportunities participating in those kinds of deals.
And it's safe to say that even with, this type of issuance, and we'll talk about it with investment grade as well, but with this level of issuance, whether it's, someone that's been doing it for a very long time, or some, like we were just talking about, are more infrequent issuers, there's been an appetite. I mean, these bonds have been gobbled up, across the board, correct?
Absolutely. If you think about it, think about the treasury market, where the 5-year treasury, I think at the beginning of the year, was something like, I don't know, maybe 170 basis points.
Yeah.
And today it's 30 basis points. Yeah. And of course you can go on down, that's more relevant to that part of the curve is more relevant to the high yield market. But the 10-year treasury, I have it right here, was 1.92%, and now it's closer to 0.7%.
Yep.
So you're starting with a negative real yield in the U.S. Treasury market, let alone the $17 trillion of negative yielding debt around the world. So there's huge global demand for fixed income securities that have a positive real yield as a starting point. In the high yield market, right now is one of the safest, most transparent, most liquid markets where you can start with a positive real yield. Not to say, there's plenty of risk in the high yield market, but it's a very small subset of the global fixed income universe that starts with a positive real yield. You could say the same thing about investment grade March, April, but as time has moved on, now a good portion of the investment grade market in the US is below the rate of inflation, or below, below where the Fed is working like crazy to get inflation for the next 5 years. There's huge demand globally for credit in the US, both investment grade and high yield.
And you mentioned, and it actually flows right into the next question. And you talked about the relative safety in high yield and investment grade credit. And one of the reasons for that is the Fed's involvement in those areas of the market. So whether it's the primary market corporate credit facility or the secondary market corporate credit facility, they've been put in place to provide this support for the credit markets. And when you look at what those facilities have done, well, first of all, the primary market corporate credit facility hasn't even been used yet. And that's $500 billion, just overused term, but dry powder waiting to be used if needed. The secondary market, as of October 8th, had purchased about $13 billion in ETFs and bonds on the secondary market, which is only about 5% of the allotted total amount for the secondary market corporate credit facility. So the Fed stopped buying ETFs in late July and has reduced the average daily bond purchases to about $21 million a day. So really not a whole lot. But, it's not the activity, I should say, of the Fed in the market, but it's more, what the Fed has said they would do. So what has been the impact on both high yield and investment grade, from these facilities that were created And do you think that they've achieved their goals?
Yeah, I mean, the impact has been huge, but it's been due to the signaling of the programs that they put in place, as you discussed, not their actual participation in the market. I mean, we are not a large corporate bond shop at all, and we're much more active in the market every day than the Fed is. So that $13 billion is relatively nominal, but the signaling is hugely important. And what I think it does is it really sort of suppresses that left tail of the corporate bond market. And of course, the Fed is focused on non-financial investment grades for the most part, corporate bonds, also post March 22nd fallen angels, and high yield ETFs. But it's very much focused on the investment grade market, but it still has a massive impact in the high yield market as well. And I think that that's something that even if this tool is put back into the toolkit, it's still going to have a huge impact on the market, because we know what the Fed, in partnership with Treasury and Congress, can do. And I would fully expect, with one caveat, that they would do that in similar circumstances for the foreseeable future. And I think the logic is, I mean, we have a very finance-based economy. That's just the reality of it today. And there's something like $36 trillion of equity value in the US equity markets, and $10 trillion of corporate bonds, both investment grade and high yield, and leveraged loans, and private credit. It probably adds up to something like $10 trillion. So if you allow that $10 trillion to seize up and to be materially impaired, you're going to do huge damage, like we saw between February 19th and March 23rd, to that $36 trillion of equity value. And that has a massive impact on the real economy and inflation and everything else. So I think from a political standpoint, and from the Fed and what its statutory objectives are, they're going to step up quickly to arrest the decimation of the value of US equities. And that will continue. The one caveat is inflation. If this happens in an environment when inflation is out of control, maybe the market sees up because of inflation, now all bets are off. I mean, now we might have to go back to the Paul Volcker recipe of the late 70s, early 80s, where he voluntarily, as Fed chair, put us into a very severe recession to take inflation out. And that's a major question. Would the Fed have the political will to do that again if inflation was out of control? That is uncertain, and you'll see some of that playing out in the very long end of the curve. And I think that's a very important issue to be focused on. But again, until we get to that point, all of these Fed programs are having a massively positive impact on credit.
So now I want to make sure everyone's paying attention. So I'm going to launch the poll, and it's a poll about default. So hopefully, I just hit launch. So hopefully you guys will see that. And you've got 3 options for default expectations, and people are voting. So that helps. So while the poll is coming in, Bill, I'm going to ask you my question on defaults. So in the throes of the crisis in March and April, high yield market was pricing in a default rate somewhere in the low teens. Much like what we saw in 08 and 09, when spreads were equating to an assumed default rate in the low 20%, expectations have thankfully not met with reality. And currently default rates have stabilized just under 6%, with the expected sectors that you would think of suffering the most: energy, leisure, and retail, in a period when no one's doing anything and everything's somewhat locked down. So Bill, are you expecting an increase in defaults in the coming months, or do you believe that the market has already hit the peak level in defaults? And before you answer, I will tell you that the survey or the poll is split 50-50, steady at current levels just under 6, moving higher through the end of the year. And that splits 50-50 between those two. So now I'll put the question to you.
I X'd it out. Was there a third choice?
There was a third choice of headed lower from here, which no one opted for, but I had to put in there just because it had to be there.
Interesting. Well, I would be somewhere between stabilizing at these levels or headed lower. And the numbers, by the way, distressed exchanges, it depends on what data set you're using. I tend to look at defaults plus coercive or distressed exchanges, which my numbers are probably more in the 6s, high 6s, and probably because mine include distressed exchanges. But they have leveled out for the last 4 months in a range of high 6s to low 7s. And my expectation is that we will not have a materially higher spike from here. And there's a few reasons for that. One, as we've talked about several times, all of that issuance, close to 20% of the high yield market between March 23rd and the end of September, that has a material impact on the fundamentals of the high yield market. It's totally different. Think about the other extreme. If you can remember in the news when Hertz had filed for bankruptcy and the equity was there were a number of speculators in Hertz equity, and Hertz tried to raise $1 billion of equity in bankruptcy, and ultimately they were not allowed to do that. I think the SEC probably prohibited the company from doing that. But the price of Hertz stock in that scenario means nothing. That's just pure speculation. It has zero impact on the fundamentals of Hertz's situation. Totally other end of the extreme is the high yield market where 20%, close to $300 billion in 2 quarters. That's actual cash raised on a $1.45 trillion market, most of which has gone to refinance debt, much of it at lower coupons and extending maturities. A smaller portion of it is sitting on company balance sheets as insurance against all of the uncertainty in the economy. Very little of it has been used for mergers and acquisitions or dividends or anything like that. So that has had a huge impact on fundamentals. That's why, as Douglas mentioned in March, market participants were talking about how's this going to compare to what we saw in the financial crisis in terms of defaults, with, again, depending on how you measure it, somewhere between 15% and probably 25% defaults was kind of the range that people are talking about, peaking out at a 12-month default rate somewhere between 15 and 25%. And then the next question was, how long will we stay there? Well, for 4 months, we've been in this, with my numbers, 6.5 to a little bit over 7% range. So I do think that the issuance is a key factor. The dollar price in March was in the high 70s. Today, it's above par. So that's a reflection. Price in March, when the dollar price is in the 70s and the new issue market is closed, now you can talk about what does price mean. But with all of this issuance and the dollar price above par, that suggests that this price means a lot. And then if you think about the equity cushion, that's our first layer of support as a debt holder, is the value of that equity. And if we think of the S&P 500 and the Russell 2000 as proxies for what has happened to the value of the equity cushion since March 23rd, well, they're up 57 to 64% before today. 57%, I believe, for the S&P 500, closer to 64% for the Russell 2000. So I think that's why defaults have come down so rapidly, and my expectation is that they will not materially spike from here. But I do expect for defaults to be above average for maybe the next 12 months or so. And then looking out into 2022, maybe we start to see a period of defaults significantly below average.
So let's take that a little bit further, and we'll move up in quality, and we'll talk about investment grade. Do you expect more fallen angels, or is the scenario that you were just explaining with the issuance and how there's been such a rally, does that diminish the concern of, as had been talked about for years, the triple B wave into high yield, where you had 55% or so of the corporate issuance in the investment grade space is triple B? Do you think that happens, or does it, what you were talking about just now, does that apply also to a certain degree in the investment grade space and staying in the investment grade space?
Yeah, and very similar analysis. I think we probably have about 160 billion of fallen angels year to date, something like that. Mm-hmm. And in March, we're talking about this could be 300 billion, 400 billion of fallen angels this year over the next 12 months, whatever the time frame was. And the market was priced for that, something like that. But now the market is priced, and I have not seen these numbers in a few weeks, so I could be off here. But my recollection is something like $30 billion of fallen angels are priced in the market now, triple Bs that are trading like double Bs or worse. And I don't have a view that would differ from the market, again, with the primary market so open in both investment grade, high yield, and potential fallen angels. I think that that's a pretty good indicator of the risk of fallen angels from here. So I don't think that fallen angels are going to overwhelm the high yield market.
So before we go to our next question, we have our second survey or poll question. So I will put that out there, and it's about the next driver of volatility. So you have 4 choices here: hard Brexit, second wave of the virus, election chaos, and an alien invasion, because it is 2020 and anything can happen at this point. So the votes are pouring in. No one's really worried about Brexit or an alien invasion, which is a good thing. Oh, nope, there's one. Okay, good. All right, we're almost done.
I might welcome an alien invasion at this point.
Yeah, at this point, yeah. I mean, we've had killer hornets and everything else, so why not an alien invasion? So, Bill, I'm going to pose a question to you, and then hopefully by the time I'm done reading it, we'll be done with the polling. So, with the election just a few weeks away, 2 weeks, I guess, the pandemic ramping up in Europe and the United States, depending on where you live. Any kind of stimulus package it feels like it's dead in the water, although every day they're talking about it. They're just not getting anywhere. And then Brexit is once more in the headlines and possibly going to fail. Bill, what do you believe will be the next driver of volatility in the markets? And is it something that I just mentioned, or is it something else? And just from the survey results, 63% say it's a second wave of the virus, 31% say it is election chaos, and 6%, or one person, an alien invasion. And no one's worried about Brexit. So I now pose a question to you, Bill.
Sure. A few thoughts. One important role for markets is to compel policymakers to take action. And markets aren't doing that much of that right now. Of course, they did a ton of that in March. They did a ton of that in the fourth quarter of 2018, as an example, to compel policymakers to take a different direction. And that we're not seeing that with stimulus. But I do think that from a purely political standpoint, the probability that, say, 6 months from now, we have a very major stimulus package implemented is quite high. But that's political. I don't think that I see no sign yet that markets are going to compel that. And it's possible that, it's possible that I think it very unlikely, but possible that we learn something today and the Senate passes something in the next 2 weeks. Low probability. Higher probability that post-election during the lame duck period, we're able to reach an agreement. And there the political calculus is, depending on how, if the election goes as the betting markets are saying right now, you would have, I think, 22 Republican senators that are up for re-election in 2022.
Mm-hmm.
And they might have an interest in, showing their ability to cooperate with the other side in a time of great need for the country. So I think it's possible and I think if the current administration loses, I think it's sort of a coin toss in my mind whether they would be cooperative and support a major stimulus during the lame duck period. If not, and the election goes as betting markets are projecting right now, I think once the new administration is in, highly likely we would get a very meaningful stimulus package. And if the current administration does win re-election, I think they're very supportive of a meaningful stimulus. And then I think, they can probably control what happens post-election with the Senate. And I think the House would be happy to cooperate. So I think stimulus, I think, is highly likely. The market, I think, is highly, basically pricing that in. And we see, bits of volatility day to day since the market has really been focused on this. The S&P 500 prior to today is down about 4% since September 2nd, I believe, when it sort of peaked and became more of a focus. But I don't think that's nothing that's going to really compel policymakers to go forward on that. These other issues could all clearly lead to volatility, but I think it's more likely that volatility will come from something that comes out of left field that we're not talking about right now. And from our standpoint, the most important thing is to be prepared for volatility. If markets are not pricing in a lot of volatility, then you want to be prepared for it because it's inevitable that they will price in volatility, and you usually don't have to wait too long. We have grown very comfortable being patient, waiting for markets to price in volatility. Now, I'm sure we'll talk further about this, but we think the markets and the high yield market is attractive right now, but volatility has been somewhat muted of late, and we don't think that we're getting a ton of compensation for that. So we're finding things to do in high yield, but we're definitely moving up in credit quality, more defensive bond structures, because we're not getting the really attractive compensation for potential volatility that we get in other periods.
So one of the things that my title is moderator, while this isn't a debate, so you can't harangue me for being a bad moderator, I guess, but I will take the other side. We've talked about the high yield markets, investment grade markets, and it's been a fairly positive picture. What is it out there in the markets that keeps you up at night, that you're worried about, that could be detrimental to either high yield or investment grade going forward? I know we've talked about, we've had the safety net kind of in place, but what is it 6 to 12 months out, let's say, that gives you pause?
Definitely from a macro standpoint, inflation is the major concern. And inflation will take time, but as soon as the markets get a hint of it, they'll pull it forward. So when it has a major impact on markets, I don't know. I'd be confident in saying we have a period of years before inflation will start to surprise materially to the upside, but markets might begin to price that in somewhat sooner than that. So that's probably from a macro standpoint. That's when this whole framework of Fed, Treasury, Congress support for the credit markets goes out the window. In terms of the second wave, it's very clear now which sectors are directly exposed to the pandemic. And, we think about how are we going to be positioned when the markets are very comfortable. Let's say that therapeutics are getting more and more effective and a vaccine or multiple vaccines are ready to go. Markets, same thing. Markets will discount that much earlier. It'll be well before those vaccines are, say, administered once or twice or 3 times or whatever they need to be. Markets will pull that forward. So, I think that is clearly a risk, but I wouldn't say that's a risk that actually keeps me up at night. I mean, you have to be judicious in your direct exposure to that. But I think that's the kind of thing where the policymakers will step up. And, the stimulus package would be even larger if that was the outcome. The credit markets are not, and the global debt markets are doing nothing to prevent us from really stepping up and backstopping the economy if we need to. But my sense is that, looking out even 1 year, we should be in much better shape on the health issues. So I wouldn't say that that's, something that's keeping me up at night.
So I'm going to put out the last poll that everyone can vote on for our final question. And I would also just remind everyone that if you do have a question, throw it into the chat room and I will then pose it to Bill. And so the next question for you, Bill, is going to be about spread levels. And the poll question: what are your expectations for high yield credit spread levels in 6 months? As you mentioned earlier, today we're just under 500, which is down from the peak of this year of almost 1,100. And where do we go from here is the question. And in the poll, 70% say 400 to 600. 73% now, 75%. Okay. I should wait until the polling's done, I guess, because it keeps changing. So the options are less than 400, 400 to 600, or greater than 600. So we're now at 71%, 400 to 600, which is, hammering in that trading range. And then 29% saying less than 400, and keeping in mind that the historic average is about 550. So, Bill, I will ask you, given that spreads are in the high yield market are now below 500 and the yield to worst is in the 5.25% range, how do you view the current attractiveness of high yield relative to equities or investment grade? And does it, reinforce the idea that high yield is a strategic allocation rather than just something that you allocate to on a tactical basis?
What was your time frame on that question?
The time frame was 6 months.
6
months. What is that? The first quarter of next year.
Yep. Well, we talked about some of that, and I said a year from now, but I think 6 months from now, fairly confident that we'll see a major stimulus package, fairly confident that we'll make progress on therapeutics and a vaccine. Fairly confident that we'll know the result of the election.
I hope.
So I think all of those things will be helpful. I think that it's instructive to look at what happened in Europe when they started a very similar bond buying program in the summer of 2016. The ECB, same thing. They started to buy investment grade non-financial corporate bonds in the summer of 2016. And by the fall of 2017, you had near record narrow spreads in the European high yield market off of a negative treasury yield curve. So I think the yield to worst was actually below 2% in the European high yield market at one point. And I think that that would be my forecast for the US high yield market. And I should say that we have built our record not by being bullish. We built our record by protecting capital during the down part of the cycle better than the vast majority of our peers, and then capturing our fair share of the upside during the strongest markets. But it's really a record that's been built on doing a better job during the down part of the cycle. And to do that, you have to know when it's time to get defensive, when it's time to focus more on not losing money than making money. But that is not our sense right now, even at these levels. And I think that the European experience is very instructive. Financial repression for years, we have seen that globally, but now, and we've seen a lot of that in the US, but even more now, where in an effort to stabilize debt to GDP levels, maybe even ultimately bring them down over time, one of the tools is for central banks to do whatever they can to keep government bond yields below inflation, below nominal growth. So it's very important for them to suppress those government bond yields. And I think that they will for a number of years, even more so than we saw the Fed do coming out of the financial crisis. And then you have this concept, the portfolio rebalancing channel. Mm-hmm. And that's where the government comes in and brings yields down, say in investment grade non-financial corporate bonds. They're already suppressing yields in the government bond market. They're forcing investors to take on more risk to generate the returns that they need to meet their objectives. And that's a very important force. It doesn't mean that you're not going to have credit cycles and you're not going to have periods of time where spreads widen and yields go higher. But I think that the overwhelming trend going forward for a very long period of time will be for those yields to come down as more investors globally come into the US high yield market to generate a yield, a starting yield above the rate of inflation. And looking out 6 months, I think it's very probable that the situation will be better 6 months from now than it is today. So I don't think that the cyclical trend over the next 6 months is going to interrupt this longer term secular trend caused by financial repression and portfolio rebalancing.
Thank you, Bill. That's the end of my questions. We're right at 1:45, so we've left some time for questions. So if you have any out there in the audience, please type them into the chat function, and I will then pose them to Mr. Zox. We don't have any right now, so I can pass the mic over to Mark if you had some closing comments. Since I don't see any questions coming in, I think I got them with all the polls. I think that exhausted them.
So now, in addition to Zoom fatigue, we have Zoom polling fatigue. Okay, another new phenomenon. So I will talk very slowly and stall a little bit in case somebody is still typing. But my closing comments again are nothing more than thank yous. Thank you, Doug. Thank you, Bill. Thank you, Matthew. Okay, I think I've stalled long enough here. So All right. The only other thing I will say is that I don't know what the weather's like where you guys are, but if you are in Columbus, Ohio, we're sending some snow your way.
Ugh.
It's sticking very nicely right now. I
No.
would send you a picture from my cell phone, but I don't want to depress any of you. So
You can go after Michigan. Leave us out of it.
Yeah, let them take it.
all right. So just pray for the jet stream to push it farther north instead of south at you guys. So
Definitely.
okay, guys, thank you again. It's always a pleasure, and really appreciate you being available today to give us all some hope for the future. Much appreciated. So take
Thanks
care,
for your
everyone.
time. Appreciate it.
Bye-bye.